Rio Tinto, Anglo American and Glencore. They had done poorly.
You've got Barrick Gold and Newmont Mining. I remember a big run in the 90s when these stocks were at 80, 90 times PE multiples. The companies that have survived, and we are looking at the survivors here, are actually really fit. The Chinese government's got this new policy of anti-involution. The gold and silver miners are just getting going. I mean, the Hochschilds, the Fresnios. If they apply this across the board with lots of metals, that will be very good for the mining sector.
Hello, with me today I have John Meyer, mining analyst and partner at SP Angel. Hello John, thanks for joining me today.
Good to be here.
Heavyweight miners, you've got Rio Tinto, Anglo American and Glencore. They had done poorly. They've done much better since early September, given the jump in copper prices. That's had a recent benefit. But do you think, what do you think of these stocks at current levels of the heavyweights?
They are worth buying, that's for sure. Again, a lot of money in the market had gone into US tech. Nvidia, all the AI stocks, and a lot of that. So the mining sector itself was looking pretty cheap. I mean, you've got Barrick Gold and Newmont Mining at 15, 18 times PEs. I remember a big run in the 90s when these stocks were at 80, 90 times PE multiples. So we've still got a long way to go on this.
Yeah. And any of those in particular stick out for you, the Rios or Anglos, or are they more broadly positive on them?
Normally we do look to differentiate a bit, but I think we're in the sort of market where they're all going to do well. Probably Glencore, because of its trading division, I think will do particularly well in this environment. We've had all the merger discussions with Anglo, and then they've agreed to merge with Teck now. It's always possible that BHP might come in with a rival bid, but it feels slightly unlikely. Rio's, I think, has been a bit of a bystander in all that, so probably Rio's has got an opportunity to run a bit more. I think that's where I would go today.
Okay, and there's been a lot of interest among retail investors recently in small cap miners. Anyone with a good story, it seems. I've seen some very big price spikes in some of these small caps, stocks doubling or more in value. Is this something we're likely to see more of, do you think, or is it just a phase?
Remember, the junior market has been starved of cash for years and years and years, but the companies that have survived, and we are looking at the survivors here, are actually really fit. They've trimmed their cost bases, they developed their assets, and now we're starting to see the value come through. And you add a bit of cash, and suddenly the stock can grow again. So yes, there's often a lot of inherent value that is about to be released, and I think we're going to see more and more of that. I mean, over the summer, nobody was announcing anything. They were still working, but they weren't announcing anything of any great value. Now I think we're going to see these announcements happen, and I think with a better market, things will just go better.
So you think there's more to some of these small cap gold miners, exploration companies, there's perhaps more to go, or certainly more interest in them?
Well, for example, Kefi Minerals. Nobody could see how that was going to be financed for some years. Suddenly the gold price has taken off. Absolutely, I would have thought the banks would be falling over each other to try and put the money in here. And yes, it's in a tricky, Ethiopia is not the easiest of countries, but the project is ready and waiting, and suddenly it's worth, the higher gold price, it's worth a hell of a lot more.
Now, we haven't mentioned lithium yet. Prices had rallied during the summer, somewhere like 40%. That was amid concerns about supply disruptions in China. Prices dropped back since, and it's significantly lower than it was a couple of years ago. Now, what's the outlook for lithium and implications for mining companies?
So I sat down with a Chinese lithium buyer a couple of days ago, and in fact, last week I also spoke to somebody who rings round the market in China from Beijing. So we're quite close to what's going on. The Chinese government is trying to centralize control of what it can do with a lot of these metals. And in the case of lithium, it said, look, you guys are overproducing. They asked everybody to do a bit of an inventory of their resources. Some of the companies had not properly logged what their resources were. The government said, look, we're overproducing here, so they asked certain companies to shut down their operations. One of those big mines has just restarted, I believe. The Chinese guy I was talking to, he reckoned we would have another 20 or 30% uplift on the lithium price, and I think I'll go with that. The Chinese government's got this new policy of anti-involution. And involution is a medical term, normally used in medical terms, where an organ in the body is causing a problem for the rest of the body. Anti-involution is where is a policy in China where you curtail some of what's going on in the sector so everybody can do very much better. And the Chinese government's definitely using this strategy to try and help companies perform better, produce better profits, and that will lift feedstock prices. And if they apply this across the board with lots of metals, that will be very good for the mining sector. So they're certainly applying it to a degree in the lithium sector. We've seen it in some other space areas as well. And I think they're going to go further with this because I think this feeds into their strategy of driving local consumption within China. Now, the Chinese chap I was talking to looked a little bit doubtful when I mentioned this, but it does make a lot of sense. You know, they know they need to drive local consumption to absorb a lot of their products. They can't sell so much into America anymore with the high tariffs. If they know they've got over competition within China, so they're starting to regulate things, and this is a good way of doing it whilst centralising government control on what's going on.
Okay, look, so lots of things to consider. Given that, how should investors play the mining sector during the rest of 25 and into 2026, do you think? Is there further upside for the precious metal specialists and with the industrials sort of improved performance?
I think you've got it there. I think the gold and silver miners are just getting going. I mean, the Hochschulds, the Fresnios of this world, Anglo-Asians, all that sort of stuff. The upside is enormous, and the market has really forgotten them for some years. So it's just beginning to become back in vogue again. And then, yes, money I think will then flow towards the more industrial companies, the companies doing the electric vehicle raw materials, the lithium guys. Nobody's really in cobalt anymore, but other metals, tin, for example. So many soldered connections these days on all these electronic products and their cars and whatever. So there's much more of that. And the rare earths as well. Let's not forget the rare earths. Still very important. I know some people talk about permanent magnets that don't have rare earths in them, the boron, nitrogen, iron nitrogen magnets. I think they work in certain, they're cheap and they work in certain environments. But actually, if you want a car that's going to go really well and it's an electric vehicle, you want to have a proper rare earth magnet in it. It will perform better. You'll get more range and more life out of it. So, I think all these things are going to go better.
Fantastic. John Meyer, mining analyst and partner at SP Angel. Thanks very much for joining me today.
Thank you.